Welcome to Market Monday from the investment team and the trust department at the First National Bank. This is the first edition of 2024, and we're going to start by reviewing market activity in the equity market through the S&P 500 over the course of calendar year 2023, because it was pretty impressive. So starting here with the S&P, that wound up doing about just a little under 25% on a calendar year basis, which is an exceedingly strong performance when you consider the backdrop that it happened against. We've had two major conflicts flared up around the world and raging. We've got information that suggests that, the economy is starting to slow in a way that could potentially lead to a recession. And in fact, our team thinks it is going to lead to a mild recession. We've also got data that suggests inflation might not be fully under control, which would cause the Fed to have to continue to operate on its interest rate hiking cycle, which would also potentially add to pressures on the economy down the line. So, amongst all of these things, it's really significant that the market went up and the manner in which it happened. So we went up throughout most of the year, trickling up, hit a rough patch in the summer where there was a bona fide roughly 10% correction, and then the market just went strongly up from there to close into highs at the end of the year. And these are longer term highs as well. The pullback that's been pretty mild that we've seen since then is not that consequential, really. It's the first week of the year that's represented there, and it doesn't necessarily represent a change in the regime overall of the market. It could very well be just a natural pullback. Now, coming to this idea of recession that we talked about before, what does that mean? A lot of folks get really nervous when they hear that word because they're accustomed to that accompanying some type of big crisis like 2008 or like the sovereign debt crisis in the early 10s or like the COVID crisis where things shut down because recession was used in those terms as well. But that's not. Those are extreme events. And a normal typical recession, which is what we would be expecting, is just a little bit of the brakes being applied to the economy so that it can pause and regain momentum later. So we're not too terribly worried about it. Unemployment currently sits at 3.7%. And if unemployment was to rise up to the long-term natural rate of unemployment, which is considered to be 5% by most economists, that would not represent a very terrible widespread event on the economy. That would represent a return to normalcy and potentially, a return to sanity, a sane longer-term growth rate. And so we're not as stressed out about what that word means as some folks are out there. Now, with that said, it's not always pleasant to talk about a contracting economy, but it is a natural part of things, and the economy grows in a cyclical manner like that. It grows for a while a little bit stronger than average, and then it grows for a while or maybe even shrinks smaller than average. And when that's the case, it's just a normal ebb and flow part of the cycle. And let's talk about that economic cycle and what we get in the next couple of weeks in our little window into that. There's not a ton of economic data coming out over the next couple of weeks, but what is pretty consequential because it relates to inflation and the corporate profit equation. So let's start with later on in the week we get the consumer price index. So that's CPI, which is expected to show, a 0.2% month over month growth and a 3.2% year over year growth. And that is actually 0.1% larger than it was at the last reading. So that shows that there's an expectation that inflation has started to reaccelerate a little bit at the consumer level. We'll get information on the labor market. Then, the following day we get information on the producer price index, which represents input costs to businesses. So here we also expect to see rising costs from the last reading, whereas on a month-over-month metric, it was flat last time, and it's expected to show a 0.1% rise. On the year-over-year, it's expected to show a 1.3% rise versus a 0.9% rise in the prior period. So that shows strengthening inflation in the producer side of things and input cost side of things as well. With that said, it's a lot lower than what is happening in the consumer prices. So what that does is that clues us in as to what's likely to happen in corporate margins as we go forward. And, you know, it looks like corporate margins are standing pretty strong because, you know, the input costs are not rising nearly as quickly as what they're able to sell product for. So in that circumstance, that would suggest that margins are going to be strong and maybe even strengthening as we go into the year. And strong corporate margins means stronger corporate earnings, which is good for equity prices. So even in the event that we see a recession, if we continue to see this dynamic between input and output and corporate margins, we're likely to see a strength in the equity market that buoys it, even in the event that there is that recession we're talking about. So moving forward, we get manufacturing. Retail sales is going to be a consequential number, expected to show an increase from 0.3% the last time to 0.4%. We get information on industrial production, which is expected to show a decline. So you can see it's kind of contradictory. Some of this data is looking really good. Other of it is not looking as strong. We get real estate market information, labor market information, and here we get sentiment, which is very consequential, and it's expected to show a slight decay from the prior reading as well. So, some of these factors show strength in the economy, and others show potential weakening. And so it's a mixed picture. We don't know what's going to happen yet, and nobody really does. We can say that in the entire history of the Fed's intervention in monetary policy using the interest rates and the hiking cycles, it's only achieved that soft landing that everyone's talking about once. So when the media personalities are out there talking about how we're expecting a soft landing in 2024, we'd argue that the historical probability of that happening is very small. And we're not going to stand on that. We're going to go with a wait-and-see approach before we call it, and we are going to say that it does seem pretty likely. So with that said, moving into the Treasury yield curve, we've got, that has come down a little bit, indicating that, the rate expectation for the foreseeable future is coming down a little bit, but not much. If you look at 10-year paper, which we consider to be a proxy for, inflation expectations, that shows, coming in at 4% for the Treasury, that's a pretty large interest rate for the risk-free asset. So inflation is really the only input risk that is input into the pricing models for those treasuries. There is no default risk in a treasury. The U.S. government is considered to be the risk-free asset. So, the only thing that you'd be worried about as an investor is what's the impact of inflation on my cash flows. And with rates where they are, it suggests that the market thinks long-term rates, inflation rates, are going to be around 3.5%, maybe even up to 4%, because it could be viewed as a break-even rate in some cases to some market participants, so at the 10-year level. So inflation expectations among government bond investors, who are among the most sophisticated investors in the world, suggests a longer-term inflation expectation somewhere around 3.5%, and maybe even a little bit higher. So that means that the Fed's official pronouncements of we're only targeting 2%, we're going to continue to get there, might not really be what the market perceives is going to happen. And we'll have to take a wait-and-see approach. But either way, the equity market, again, bringing the S&P 500 up, is behaving in a way that says, hey, we don't really mind the higher interest rate environment. We're ready to, just go forward on that basis with a higher cost of capital, because an interest rate is the cost of money when all is boiled down. And finally, to round things out, we've got the fixed income on corporate credit. And that has also come down pretty dramatically over the past couple of weeks. But you've got 5-year paper yielding roughly 4.6%. And you've got 10-year paper yielding close to 5%. And that's great for the income investors as we start to enter the year. Income investors and those who are using bonds to hedge equity volatility risk in their portfolio. So it's a good time to be buying bonds as well by historical standards. And finally, to close things out, we looked at the 1 year here, and this is a strong market situation, but let's not get ahead of ourselves and try to get lost in what's going on in the short term. The long-term investment plan is what really counts here, and this is the time frame that we're looking on. We don't want to be making changes to great long-term plans based on short-term things that are happening in the market. So we want to, stay true to those plans. And if you have questions, if you're worried about the economy or your account or what's in it, feel free to give us a call. We love to talk to the clients and anyone that's even a prospective client. We're happy to talk. Hope you found this informative. Thank you and have a great day.